So now it's time to get officially started. My name is Mary Biddle-Koenig, and I'm the Assistant Director of the Smith Enterprise Risk Consortium, or CERC as we call it, at the Robert H. Smith School of Business at the University of Maryland. I would like to welcome you to the March webinar in our monthly Risk Leadership Series, which is brought to you by CERC, ZRG Partners, and the Office of Executive Education at the Smith School. As many of you already know, our webinars are focused on top-of-mind topics that vary from month to month. Last month, we discussed the issues and challenges in cyber insurance markets, and next month, we're going to dive into the reforming of the federal home loan banks. But today, we are thrilled to have Greg Baer from the Bank Policy Institute with us to talk about the impacts of banking, business, and on banking, business, and consumers from the proposed Basel III Endgame capital rules. To start us off, I would like to introduce you to Rob Iamazzo. Rob is Managing Director of ZRG Partners and currently leads ZRG's Global Enterprise Risk and Analytics practice. We have partnered with Rob for many years to bring you the Risk Leadership Webinar Series, and I'm pleased to turn it over to him to kick us off today.
Thank you, Mary Biddle. Once again, a pleasure to be here, truly an honor, and would like to thank Bill Longbreak as well as Greg Baer for agreeing to participate in today's discussion. We were just chatting before this, as prepping for this, just given what's trending out in the news, yesterday's decision with obviously the Fed reviewing bank capital requirements, could not think of a more topical discussion to be had today. So Greg, thank you again, and Bill, and I'll turn this over to you.
Thank you, Rob. The topic of today's webinar, as you've already heard, is to discuss the proposed Basel III Endgame rules that U.S. bank regulatory agencies have proposed to govern bank capital requirements. So we are delighted to have as our guest speaker today, Greg Baer, who is President and CEO of the Bank Policy Institute. Previous to his current position, he served as president of the Clearinghouse Association, the largest private sector payments operator in the United States. Prior to joining the Clearinghouse, Mr. Baer was managing director and head of regulatory policy at JPMorgan Chase. And prior to that, he served as deputy general counsel for corporate law at Bank of America and as partner and co-head of the financial institutions group at Wilmer, Cutler, Pickering, Hale, and Dorr. From 1999 to 2001, Mr. Baer served as Assistant Secretary of the Treasury for Financial Institutions. And Greg, that's, at best of my recollection, when I first got acquainted with you was when you were Secretary. So prior to working at the Treasury Department, Mr. Baer was managing senior counsel at the Board of Governors of the Federal Reserve System. He received his JD cum laude from Harvard Law School in 1987, and he also served as managing editor of the Harvard Law Review. And currently, he actually does continue his academic pursuits as an adjunct professor at Georgetown University Law School. So Greg, welcome to this particular webinar. And before we dive into the details of the Basel III proposal, I'd like to start with a brief history of Basel I and II, because if you have Basel III, that implies that something came before that. So Basel I was initiated in 1988 and fully implemented in 1982. It was primarily credit focused with simple weights for different categories of assets that ranged from 0 to 100%. And there was a minimum risk-weighted capital requirement equal to 80%. Pretty straightforward, very simple. Basel II then was the next step up, and that was initiated in 2004. And it took literally almost 8 years to fully implement it. It wasn't fully implemented until after the great financial crisis. It consisted of 3 pillars, and the first pillar was focused on making the credit to risk weights more sophisticated, and large banks were permitted to develop their own credit risk models. In 2006, along the way here, the capital adequacy framework was revised and combined with capital treatment for banks' trading activities. Pillar 2 was regulatory supervision. And of course, there's been a lot of talk about that in the last year, particularly since the failure of Silicon Valley Bank. And then pillar 3 was market discipline, which involved enhanced disclosure requirements under the expectation that the market would apply appropriate pressures to financial institutions. The Basel III development began in 2010 following the great financial crisis. Full implementation is still pending. This has been a long journey. And in just last year, the U.S. banking agencies proposed a set of rules that we're going to talk about today called Basel III Endgame. I'm not sure where the Endgame thing came from. It seems to me to be a little bit silly, since my expectation is the world evolves and so forth, is that there will be greater or more enhancements as time follows. What I'd like to do to kick this off here is, before we examine the details of the Basel III proposal, it would be helpful to set the stage by explaining the purposes of bank capital and why it is important to regulate it. And I asked Greg if he would be willing just to kind of explain to our audience here what the purpose of these Basel regulations are. So Greg, take it away.
Thanks, Bill. Pleasure to be here. Yeah, I mean, the purpose of capital obviously is to ensure the banks can lose money without becoming insolvent, going out of business, and potential inflicted losses, not only on their creditors, but also on the deposit insurance fund, and thereby, incidentally, on their fellow banks who have to recoup that or replenish the fund. Capital regulation is difficult because you got to figure out how to determine the appropriate amount of capital. It's all ratios, I think, as you noted at the beginning. The numerator is pretty easy. It's usually kind of complicated what counted as capital, but it's basically common equity. So what you think of as common stock, that's the numerator. And then the question is, what's the denominator? In the simplest form, the denominator is all your assets. That kind of ratio is actually called a leverage ratio. So it's just your capital to all your assets. Problem with that is your assets actually have very different risks. Subprime mortgage is very different from a treasury security. So treating them the same isn't really going to give you a very good look at how much risk a bank is going to take. It's also going to give a bank an incentive to take more risk because you want to earn a higher return if you're going to have the same capital charge regardless of the risk of the asset. So the Basel process through the years, you can think of it as sort of a debate about how granular do we want to be in assessing the risk of a bank balance sheet. Basel II more granular than Basel I. Basel III, which some people actually call Basel IV, but that's another story, more granular than Basel II. There's also a debate about the role of bank models in determining those risks. Clear advantage of bank models is they're much more granular, they're smart, and they can be constantly back tested. But then on the other hand, you can have a standardized model that doesn't really change, but you don't have to rely on banks to play any role in the process. So that's a big debate, and I think we'll get to that with this proposal. When you think about the risks that you think about in the denominator, Basel looks at 4 risks at this point. First is credit risk. So if it's a loan, the risk that the loan's not going to get repaid and you're going to lose money on it. The second is market risk, which is if you own a security and the risk that it's going to go down in value, not necessarily default, but go down in value because of market fluctuations. The third is operational risk, which is kind of an everything else kind of risk. But, in reality, in theory, it's things like cyber risk, but it turns out banks don't actually lose a lot of money on cyber. What become over time is litigation risk. So think of huge fines being imposed by regulators, huge civil judgments. So the idea is, which I could debate, that banks need to hold capital against the risk that their regulators are going to fine a lot of money in the future, and there'll be attendant civil litigation. The fourth, which I hope we won't get into because it's incredibly technical and doesn't talked about a lot, is called credit valuation allowance, which is basically, it's a form of credit risk. It's basically the risk that your derivative counterparty is going to default. It really only applies to a few banks and is pretty arcane.
Well, thanks, Greg, for that background. Now we're going to explore the first 3 risks that you mentioned here in a moment, but let me set it up here for you, and then we'll go through each one of them. On the 16th of January of this year, the Bank Policy Institute and the American Bankers Association jointly submitted 2 comment letters critiquing the U.S. banking agency's proposals to implement revised capital requirements. And I'm going to quote from the press release that accompanied the sending of those letters to the banking agencies. And to quote, the banking agency's Basel capital proposal would impose significant, unjustified, and permanent costs on U.S. businesses and consumers, and provides no evidence banks hold insufficient capital against the 4 risks addressed in the proposal. And then there were 2 comment letters that were submitted. The first comment letter discussed substantial methodological flaws in the proposal. And the second comment letter asserted that the agencies failed to adhere to the Administrative Procedures Act, which sets out requirements for all federal agency rulemaking. So let's explore, Greg, the problems that each of these comment letters delineated. And we'll start with the one that discusses substantial methodological flaws. So I'd like to to start with operational risk, because that one seems to be really very deeply flawed. It's an attempt, as I understand it, to require capital for banks' non-asset fee businesses and other non-financial risks, such as strategic and reputational risk. And the first question I'm going to ask you is, in your opinion, what is the purpose of including a capital charge for operational risk?
Right. Well, first, it's worth noting that until Basel III for the U.S., there has not been a capital charge for operational risk. The theory's always been, well, if you're holding capital for credit risk and market risk, and you have some operational problem, well, that capital, if you can't make that up from your earnings, the capital you're holding for other purposes is sufficient. So this is a whole new concept for U.S. standardized approach to capital to include an operational risk charge. Again, in theory, banks make mistakes all the time, a processing error, somebody embezzles some money, you have a cyber event. And the theory is you should hold capital against that. Again, as noted, they don't really lose a lot of money on that. All the major losses that are categorized as operational risk losses are civil litigation and government fines. And so that is what this has become. Our point sort of conceptually is there's no reason to think that a fine for having bad any money laundering detection is going to correlate with a credit event or a market event. So why would you have that be a purely additive charge as opposed to just letting $1 capital serve, a variety of functions? But even if you assume that you need that, the question is, well, how do you predict how much your future litigation and losses and fines are going to be? What Basel does, which is kind of weird, there used to be an attempt to try to model that. The models were terrible and nobody thought they were any good because it is kind of hard to predict. In fact, if you have a big loss, you're, in whatever area, say it's anti-money laundering, you're probably going to rebuild those systems and hire tons of people, and your chances of a future loss are going to go down, not up. But so they came up with, well, we're going to have a simple measure, and we're basically going to say, as you make more money, your losses are going to go up. That's part one. And then the second was there actually was an attempt to say, we're going to take that baseline, and then to the extent that you've had large past losses, we're going to multiply your first number by something, above 1 if it's bad history, potentially below 1 if it's good history, although the U.S. didn't allow the below 1, and that's going to be your operational risk charge. There are a lot of problems with that conceptually, that it really isn't that predictive. But also, we did the research, our economists here, the largest year of losses for what people call operational risk was actually 2014, because that's when most of the litigation from the global financial crisis in the U.S. either settled or the banks established reserves for it. The charge in the Basel proposal is 3.5 times the size of the losses in 2014. So 3.5 times the absolute worst case in history coming out of a global financial crisis. So, there are conceptual problems with it, but even if you accept the concept, the number that was produced was inordinate.
So in your analysis, as I recall, you actually said that the way in which it was proposed and structured resulted in double counting, that there was overlap with the credit capital charge. Can you explain that?
Oh, sure. Great reminder. I did not include that in my case in chief. So this was a Basel construct negotiated in 2014 and now being implemented in the U.S. Basel was thinking about that. The Federal Reserve, the rest of this is all the agencies working together, more or less. The Federal Reserve instituted in the United States basically a stress test, which 2020 became a capital charge. And so they basically said, if things go really badly wrong for credit, so assume a recession far worse than 2009-10. If things go really badly wrong in markets, assume worse markets than 2009. And then if things operationally go really badly wrong, how much more capital would you need? And so they take that and they put that on top of the Basel requirements. Again, the US is the only one that does that in general, and certainly operational risk. So, the rest of the world will have the operational risk charge in Basel. The US appears to be proposing, unless they're going to change the stress test, to have 2 operational risk charges, which is hard to understand. I mean, there is a theory on credit risk. Well, your regular Basel charge is sort of BAU losses, but we need, what if something goes horribly wrong? So we need a stress event, and we're going to add the stress event. But operational risk is all stress. I mean, there's no different. You don't lose $1 billion in judgments every day. So it's either way, it's a stress test. And now the US potentially is looking at 2 stress tests. So it does not seem to be any rationale for retaining the stress test operational risk charge once Basel is implemented in the United States.
Okay, well, the stress test, but as I recall too, Greg, that some of the research that the Bank Policy Institute has done has actually suggested a way in which the overshoot on the operational risk charge and its intersection with the capital risk could be fixed.
Oh, sure. You're going to need to get the number down even to 2014 levels, which would be high. I mean, they're going to need to make substantial changes to the Basel proposal and probably eliminate the stress charge as well. It's just difficult arithmetically from what they propose to get down. The big issue there, and this may be too in the weeds, is in the Basel proposal for there are 2 ways banks make money: interest income and non-interest income, also known as fee income. Basel proposal, or the Basel rule, actually recognizes, and the other jurisdictions that have adopted it recognize that with regard to interest income, as you start making more money, you don't really have more risk for operational risk. If interest rates go up and you're earning a higher rate, that doesn't mean you're going to more likely have a litigation judgment. So they basically capped how much your operational risk charge could go up for interest income. They did not put a cap on fee income, which really hits US banks the hardest, because US banks are bigger in the businesses that have fee income. So that would be credit card, investment banking, custody services, and payment services. And so that number is uncapped and really unlimited. And that's where you see the massive charge for US banks, and really only US banks. And so they're going to have to do something pretty significant on that front if they're going to bring this down to a rational level.
Okay. I see a question coming in from okay. The question is, this is someone's is the FDIC's risk-based deposit insurance premium formula sufficiently forward-looking?
Specifically.
Well, I think we have a lot of everybody's feeling that acutely, because the FDIC just did a special assessment for the Silicon Valley bank losses, and now has announced that it's going to be dramatically higher for reasons that I think people are having a hard time understanding. In theory, the FDIC's assessments should be capturing risk. There's actually a kind of a statutory requirement on that, but there was a change called the Tester Amendment way back when that actually changed the deposit insurance base to be all of your assets as opposed to your insured deposits, which is odd. So shifting from liabilities to assets, and then basically treating, if you assume the balance sheet's equal, treating non-deposit liabilities just like deposit liabilities in terms of potential exposure for the FDIC. That doesn't make a lot of sense. I think there's a lot of work to be done on the FDIC. They tend, I think for reasons that are largely political, to impose a proportionately higher fee on the largest banks than smaller banks, probably leaving risk aside. And I think that's going to be very controversial going forward. You know, there's proposals out there now to have large banks, the regional banks hold long-term debt to further insulate the FDIC from loss. Of course, if that's adopted, their deposit insurance premiums should go down because they're less risky to the fund because you have a whole nother layer of loss. But it's interesting to see if the FDIC will recognize that fact.
You know, that's interesting. You know, just reflecting, Greg, back on the events of the last year with Silicon Valley Bank. If they don't get deposit insurance right, they can always come back as they have and levy a special assessment. So.
Yes. I mean, it's something that's always good reminding the public that the taxpayer doesn't actually pay for these losses. The banks pay for these losses. I mean, one of the bitter ironies of Silicon Valley Bank was, I think, the biggest beneficiary as an uninsured depositor who got paid was actually a stablecoin issuer. I think had a couple of $1 billion at the bank. And so basically the nation's largest banks all wrote a check to a stablecoin issuer for leaving the money there too long.
Probably a topic for another webinar.
Yes. Can't wait. Actually, I want to do federal home loan banks next week too, but
yes,
regular.
So you, in your letter, you commented that the operational risk charge as proposed would have some very potentially devastating impacts on U.S. businesses. Can you give some examples of the types of concerns that you have?
Sure. I mean, devastating may be a little strong, but certainly they would incur the charges. I mean, banks tend to pass through higher costs, and of course, a higher capital requirement is a higher cost. The market still demands that you earn a competitive return on equity. What's been interesting this time, and you might have seen some of the reports about the comment letters that went into the Fed. This is the first time that I can ever remember, anybody can ever remember, where bank customers are actually engaged on a bank rule, a bank regulatory rule, where you heard from small businesses, asset managers, groups, civil rights, consumer groups representing low and moderate income people. And I think, you know, somehow a switch got flipped. I hope our research had something to do with it, that basically, you know, banks allocate capital, you know, to businesses based on the returns they can earn. That return is largely, you know, not large, is certainly partly driven by the amount of capital they have for that business. And if you increase the capital, they've either got to raise their prices or reallocate away from that asset. You've certainly seen that, you know, post-global financial crisis in certain areas, you know, mortgage being one, where that's now predominantly a non-bank GSE business as opposed to a bank business. You've seen on the wholesale side a significantly diminished ability and willingness of banks to hold capital for market making, which even as, you know, corporate bond issuance and actually treasury issuance has skyrocketed, the market depth in those areas, that is the inventory that the dealers are willing to hold, has decreased significantly, which has made those markets much more fragile. So I think, you know, there's a whole set of commenters around that, including some folks from the Hill. You know, it's difficult to gauge how much, although actually the Basel Committee has a little formula about, you know, if I always forget the formula, somebody should Google it. You know, if capital requirements go up by X, then GDP goes down by Y, and they have a little formula for that. You know, of course, the trade-off is, you know, if as bank capital goes up, you know, the chances of banks failing and there being a financial crisis goes down, and that's not unimportant. Of course, you know, you live and regulate at the margin, and the question is, have we gotten to the point where the costs of higher capital are higher than the benefits? I think the case for that is pretty strong. I mean, we've now seen, you know, post-global financial crisis, I think capital levels of banks have doubled, probably closer to tripled. You know, you've seen banks ride out, you know, recessions, pandemic, 2023, and yet this proposal presumed that they needed, I think on average, the Fed said 16, I think probably closer to 20% higher capital. So effectively found that the US banking system was critically undercapitalized when nobody believes that. So I think that's sort of where folks started, and with sort of an astonishment at that finding, particularly when that was at war with the adoptions that we saw in the EU and the UK as well.
So just let me probe this a little bit, Greg, here. Some have suggested that bank capital actually should be raised considerably more than even as proposed in Basel III, but there should be a trade-off, and the trade-off would be a substantial reduction in the regulations that really, the depth and breadth and the tediousness and the costs of compliance with proliferation of regulations. You should increase capital and then reduce regulations simultaneously. Do you think that would have any potential benefit in terms of banks operating more profitably and being more effective?
Yeah, it's funny you say that. I mean, I often make the point that and it's funny because I'm actually, as just before we started, I was working on a note about how badly broken the examination regime is in the United States, and how examiners are increasingly focused on sort of management consulting and things like vendor management and and risk culture and IT systems and things that aren't really financial risks. So there's certainly a surface appeal to that trade-off. And of course, as bank capital gets higher and higher, what constitutes a material risk to the bank should also be getting higher and higher. And therefore, examiners should be spending time on fewer and fewer issues because more and more of them are becoming immaterial. What we have seen, though, in the last 15 years, it's exactly the opposite. I mean, just as banks have built capital, built their liquidity, become more resilient, what constitutes a material problem to the examination teams has gotten smaller and smaller, and they are now focused on trivialities and on things not financial risks to the bank, and are more akin to management consulting. So, I mean, in theory, I'd love your trade-off. I'm not sure about the significantly higher. I think we're already that high, but that's not happening in this world anytime soon, unfortunately.
All right. Well, actually, I share your pessimism about that.
Mhm.
Let's explore the credit risk aspects of the capital of the Basel III proposal. And the credit risk weights have been revised substantially for some of the different asset classes. And I'm just wondering, why did the agencies decide that they needed to do that? And then there's a second part of that question, is that in Basel II, larger financial institutions were allowed to create their own credit models. And Basel III proposes taking away that flexibility. And so I'm just wondering if you could comment on both sets of questions, both the risk weights and what you see as some of the problems with the proposed revisions, and then the use of bank credit models.
Yep, that's great. So on the first, what the U.S. regulators did was they effectively took the risk weights in Basel for credit card and retail and just added 20 basis points to all of them. So for mortgage, whether the Basel has sort of a range of loan to value ratios and an associated capital charge. Obviously, the larger the down payment, the lower the capital charge. And the U.S. regulators simply added 20 basis points to all of them. Actually said in the proposal, I was telling some folks in Europe this, they couldn't believe it, why they did it. And they did it because they wanted to enhance the competitiveness of community banks. Because they said, well, if you have a lower capital charge, large banks will be able to lend at a lower rate than community banks. There are a couple of problems with that. The first is that's not the role of capital regulation, to be sort of handicapping to make everybody equal. The second is there's a really easy solution to that problem, which is to lower the capital charge for community banks if it's too high. And the third is community banks don't have a GSIB surcharge. They don't have an annual stress test and a stress capital charge. They don't have the weight of examination supervision on them. So the notion that they're really having a significantly lower charge that large banks are is fanciful. So that was their putative rationale. I expect that's probably going to go away in the final rule. I mean, the bigger issue, and I'm glad you mentioned it, is the issue of internal models. There's this notion, you can't trust banks to model credit risk because they'll cheat. The issue with that, though, is since 2000, I think it's 11, under Basel II, banks have been modeling credit risk. So that's now for 13 years. They do it under a regime specified by the banking agencies that includes audit, compliance, and then examiner review. They have to back test those models. And if the models are showing outcomes that are too high or too low, they have to correct the models. And by all accounts, that system has worked great. There's been no enforcement action ever taken against a bank for systematically understating its risks. The regulators until now have never said, there's a problem with the internal models. And then the sort of bitter irony for U.S. banks is the whole point of the 2014 Basel Accord, to which they agreed, was to keep bank internal models. And the notion was basically we're going to have a standardized credit risk model. You can run your bank internal models, and this gets a little wonky, but in aggregate, those bank internal models can't produce capital charge less than 72.5% of the standardized charge, which they called an output for. So the basic notion is we're going to let you run internal models, but they can only produce so low a charge compared to the standardized. And that's what everybody held hands and agreed to. And that's how the EU adopted Basel and the UK adopted Basel. It is only the US regulators said, nope, we're going to get rid of bank internal models entirely. And effectively, that charge is not going to be 72.5%, it's going to be 100%. So basically, US is going to be, for credit risk, 72.5%, 27.5% higher than Europe and EU, Europe and UK, and what Basel envisioned. They provided no rationale for that in the proposal. They provided no documentation that existing models were understating risk. And the effect of that was massive because effectively all the rest of the world is going to have a 27.5% discount on the Basel standardized approaches, and the US is going to get a 0 discount. And that really, really drove the number up in terms of the impact on US banks.
Well, that's a competitive disadvantage potentially for US banks and that compete internationally. But it would seem to me there's another huge problem in not allowing internal models to be used. Because in my experience, Greg, you know, a lot of the lending, particularly in business, commercial lending and commercial real estate and so forth, is very idiosyncratic. And determining the risks, that's done very, very well in my experience. But just assigning a flat out capital charge without respect to analyzing the different aspects of a particular loan doesn't seem to me to be very sensible, or worse, it could lead to signals to banks to not make certain kinds of loans, like to low and moderate income borrowers or community development loans that inherently have more risk. But the banks themselves could be prepared to handle that if they were allowed to use internal models. I'm just wondering what the reaction of the Bank Policy Institute is to that.
No, Bill, that's exactly right. That is a great and probably the most important point. I mean, the other point, which is sort of a subset of that, is you're also sort of concentrating risk in the banking system, because if you favor a certain asset in a standardized model, well, that same model applies to every bank. Whereas, ideally, if you think about the business of banking, you're really competing on your ability to manage risk, and you want banks to have different views of risk. And this is effectively saying you all have to have the same view of risk, and that's a real problem, I think. And I think it's one that, academics have expressed some concern about as well.
I mean, we have, in the institution, I'm on boards of directors of banks, Greg, and, we have model review processes. The board of directors pays a great deal of attention because we're concerned about the risk to the bank as well. And it would seem to me that the bank regulatory agencies, they can do that too, but to rely on that kind of process rather than just setting up arbitrary risk-weighted models that don't take into consideration the risk assessment process, which in my experience is very robust. It might result in a few more bank failures along the way, but it would seem to me that the consequences in the other direction of not allowing banks to actually do what they're supposed to do, which is to assess risk and price risk appropriately and manage that, would actually be to the detriment in the long run to the economy. Anyways.
Yeah, I was saying, another unintended consequence I should have mentioned, it's a little more subtle, but, even if you have a very similar type of loan, some banks invest a lot in workouts. If you think about commercial loans, and because they invest a lot in workouts, their loss given default is much lower and they avoid default. Other banks just simply foreclose and sell off the loan. Now, if you're going to tell every bank, well, we're going to give you the same standardized charge whether you work out the loans or not, well, then what incentive do banks have to do those workouts? Because effectively they're being punished for it. So, I think that's just yet another sort of consequence where, again, a bank internal model would actually factor in the fact that we have a lower probability of default or lower loss given default because we have these great workout teams, but a standardized approach ignores that entirely.
Well, look, I'm going to move along here to the next risk, which is market risk capital. And in your comment letter, you stated that increases in market risk capital requirements were outsized. So can you explain why you believe that to be the case?
Right. Well, part of this goes back to they're particularly outsized for the United States because we're going to have effectively two charges. But just to give a little bit of history. So if you think about, I mean, again, there's a sophistication of the whole audience, but I can make this simple. I mean, traditionally measured market risk through a methodology called value at risk. And effectively what you said was, out of 100 trading days, we want to make sure that you have enough capital that for 98 of those days, you're going to be fine. And you sort of did that historically. You knocked out the couple of worst trading days, and that's basically what you held against, and that was historical. Obviously, the global financial crisis showed the problem with that, particularly in mortgage, where, if you look back 3-5 years, there hadn't been any losses. So you just assume there would be low losses going forward. But, original Basel, sort of assumed that on market risk. They actually called it Basel 2.5 just to make it even more complicated. But it was basically a value at risk methodology. So the decision was made after that. Well, we don't want to capitalize for the majority of the times. We actually want to capitalize for the tail. We're more worried about those 98, and you need to hold capital against the 2. What happened, though, was Basel spent years working on this and came up with a market risk approach. Bizarrely, it's called the Fundamental Review of the Trading Book, but it's just market risk capital. Meanwhile, the Fed, again, pre-adopted, years ago through what they called a global market shock. So the global market shock basically says, assume big drops in value of your securities and assume that you can't trade them for a very long time. So capturing illiquidity risk. And that's what the large US banks, the trading banks, we're only talking about a handful of banks here. That's what they have to hold currently in the US. Again, though, Basel now has said, okay, well, we're going to do the same thing. We're going to have a standardized approach that looks for illiquidity in tail events, and you're going to have to hold capital against that. And that's what's been adopted again in the EU and the UK and lots of other places. The primary problem with the US is that we seem to be on a path, well, maybe not so much recently, but to doing both. There's also sort of a technical problem with the European approach or the Basel approach, the Fundamental Review of the Trading Book, which is, this is an area they recognize you actually have to use bank models for most cases. But there are extreme penalties to the extent that anything goes wrong with that bank model, whether that's a data problem or a correlation issue or something like that, in which case you suffer this massive penalty rate, either through a stress test or through a standardized approach. So, I mean, I think certainly our comments focused on that sort of punitive nature of the proposal. I wouldn't be surprised if it changed, but basically to make this a more accurate reflection of true market risk, even on the tail, you would need to make some changes to the Basel component, the FRTB, and then really rethink the global market shock and the stress test.
So let's dig a little deeper into the FRTB. I think I've got that right.
Yep.
So do these proposed rules exacerbate, in your opinion, primary dealer balance sheet capacity and their market making activities? And then the second part of that question is that what are the implications of the proposed rules in terms of treasury market liquidity and resiliency?
Okay, I'm going to see that too. Yeah, I mean, look, I think there is a version of FRTB that would not exacerbate and would be rational, particularly if it was not accompanied by a duplicative charge and a stress test. The standardized approach, the FRTB, is immensely complicated. And I think what you just have to take on board, and there's no answer to this, we have no answer to this, no matter how you structure it, banks are going to move in and out of asset classes, at a desk level, because these guys, they're smart like foxes, right? And they will spot in any standardized approach a place where you can make more money and a place where you're going to make less money, and they will move out of the less and into the more. So that's just sort of the nature of the beast. I think it kind of accepts that. I don't think anybody is saying you shouldn't have a capital charge for market risk. And as I noted, the FRTB actually does use bank models. So it's about as good as you can do. Again, there's a little problem with disqualifying the bank models, but I don't think anybody has a fundamental problem with the Fundamental Review of the Trading Book. Again, I think it's around model disallowance and then really in the US and the US alone, they overlap with the stress test, which they've not put out for comment, which we believe to be illegal, and which I think now really ought to be up for bid. On treasury markets, as I noted earlier, I mean, these, I guess they still are, the most liquid market in the world. And yet we've had to have the Fed intervene in 2019 and then again in 2020, become what they said that they would never do, which is be the market maker of last resort in treasuries. Again, a lot of that is diminished dealer inventory in that market. The causes of that are very complex. I think originally the largest problem was actually a leverage ratio, back to what I was saying at the very beginning, because what gets punished by a leverage ratio? Well, holding treasury securities, which is a liquid, riskless asset, and yet has a large capital charge under US rules. I think over time, though, the risk-based, and this gets really complicated because at different times, a different capital requirement might be the binding constraint. I think now the bigger issue is the stress test and the capital charge it imposes on treasuries. And then for the largest banks, which are dealers, there's also a GSIB surcharge, which is basically tries to measure their systemic risk. But a lot of their systemic risk is just how much securities trading they're doing, and that includes treasury trading. And so that's a further surtax on being active in treasury markets. I think now the SEC is trying to move to an intermediated sort of clearing model, and we'll see if that works. But I don't think it's necessarily a panacea, although I would say this is when I get a little over my skis, because that is a very, very complex topic.
Okay, well, thanks. I don't pretend to understand it myself. Do you think that if the stress tests are fixed, that the market risk proposals in Basel III would be workable, or do they still need additional work?
I think workable. As I noted, I do think they need to. The way I put it is, if your model falls out of compliance for some reason that isn't grievous, you need to go on probation instead of going straight to prison. And
Okay.
what really drives the projected numbers on market risk under FRTB are the fails on the models. So if they tidy that up, and I don't see any reason they couldn't and wouldn't, and then you eliminate the sort of redundancy with the stress test. It may not mean eliminating the market risk component of the stress test altogether. It just needs to measure different things from what FRTB is already measuring. If you did those two things, I mean, you could come up with I think a far more credible, constructive, and not too damaging, market risk rule.
Okay, well, I got to shift here a little bit. As I recall, Governor Bowen of the Federal Reserve System made comments about capital tailoring. And I think in your comment letter, you suggested that the Basel III Endgame rules were kind of a backdoor way of repealing capital tailoring. And perhaps for the benefit of our audience, you could explain what this issue is all about, what tailoring is and why it's important.
Well, it's certainly been a hot topic. I mean, it was enacted by Congress, God, I can't remember how many years ago, 18. And basically the notion was you shouldn't regulate a regional bank like GSIB, which makes a lot of sense. It ended up having a lot of components. I think post Silicon Valley Bank, there was sort of a relook at like, well, was tailoring a problem there? We've actually published a fair amount of research showing it really wasn't. And even if the sort of GSIB-like rules had been reimposed on Silicon Valley Bank, it would not have mattered. But leave that to the side. The question is, what rules should apply to a $100 billion bank in the same way that they apply to a $2 trillion bank? I think it's not really Basel, but as part of this sort of package, there was something called an AOCI filter, which meant that you didn't have to recognize decreases and increases in the value of your securities held in your available for sales portfolio for purposes of capital purposes, or for purposes of capital adequacy. I think it's pretty clear that the agencies are going to get rid of that, and we support that. So that's, I think, unobjectionable. On the capital side, I think where we're heading is probably back to tailoring of a sort. Just to make capital even more complicated, there's something called the Collins Amendment in the US law, which says that your requirement is the higher of Basel III, or whatever number of Basel we're on, and old Basel I. It's really arcane, but basically they still apply the old standardized approach from, 19 whatever. And the way it turns out, I think what's likely is we're going to get tailoring on Basel, because if they make the changes everybody's expecting them to make, the regional banks aren't going to be bound by Basel, going to be bound by Basel I and the Collins Amendment. So I'm not even sure they're going to apply it to them because it'll never be binding. The bigger issue now, and this is outside this scope, is there's a long-term debt requirement that was also announced at the same time as Basel, which is extremely problematic for regional banks. Basically moves them away from deposit funding towards very high-cost market funding, more along the lines of what's in SIB. And I think that's attracting a lot more attention on the tailoring front. There's also just little stuff like, the Basel require them to calculate their market risk when they have no market risk. Not a financial constraint, but just a massive operational cost. So I think things like that will probably get tidied up.
Well, you're being an optimist, Greg. Let's turn to your second comment letter, which you said quite bluntly that the agencies in proposing this rule had violated the Administrative Procedures Act. So, what could explain for the benefit of the participants in this webinar what you believe the agency should do to actually be in compliance with the Administrative Procedures Act?
Sure. I mean, there are two components or two potential flaws under the APA. The first is a procedural and the second is substantive. Procedural basically just boils down to show your work and allow people to have a meaningful opportunity to comment on it. The second, which you probably hear more about, is the phrase arbitrary and capricious, which is sort of as a substance matter on the merits. Your rule has to make sense, just to put it simply. So in other words, it cannot be arbitrary and capricious. It has to be based on substantial evidence in the administrative record. We believe this proposal fails both prongs. If you think about, say the risk of default on, a credit card or a commercial loan, there's actually voluminous data in loss history there, going back decades. The agency's actually collected on the call reports. It's available, publicly. It's available privately. And yet, when you read the proposal and the risk weights that they've proposed, they included none of that analysis at all. They simply took the Basel risk weights that were negotiated in 2014 and themselves included none of that analysis, at least publicly, and then they added something to it. So I think that's a procedural failure. It's also kind of the process and substance kind of merge, but they just didn't do the work. They didn't show the work. Again, on the internal models, as I noted earlier, provided no evidence whatsoever that the existing rule is in any way deficient. And then that sort of goes through. And then op risk, again, as I think I said, they've come up with 3.5 times the worst year ever in American history and provided no analysis to support that whatsoever. No analysis to show why your income is predictive of your operational risk losses. And then really arbitrary, as I think I alluded to, they basically said past loss history can increase your capital charge, but it can't decrease your capital charge. There are lots like that. I mean, basically for every asset class, they're requiring, actually, this is one where it's currently understated. If you have an unused line of credit, for example, on a credit card, there's currently no capital charge for that. So if you have a $2,000 line and you're using $1,000, well, I should do a number that doesn't. If you have a $3,000 credit line and you're currently using $1,000, the bank doesn't hold capital against the $2,000. There's a good argument that they should, on the theory that you might draw that. Apropos, just sua sponte. The agency's proposed a 10% charge on that $2,000. I think the analysis we've done show it should be 5%, not 10%, but they provided no data or analysis whatsoever to justify the 10%. That actually has a big impact. And this is one of the things I think some of the consumer groups have pointed to, because a lot of low and moderate income people use that credit line as an emergency line of credit instead of, going to a pawn shop or a payday lender. And so if you tell a bank you got a 10% capital charge against money that's not being used, well, that's the worst thing about it. I'm sure you know better than not. That's the worst thing in the world you can tell a banker is you're not even lending the money and you're holding capital against it. Well, I'm going to close everybody's line or shrink everybody's lines. So again, just that little arbitrary action has a massive potential real world consequence.
Yes, absolutely. Well, as a former banker, now a bank director, we are always focused on ways that we can conserve the use of capital. So it's a very powerful incentive. Yesterday, and I know you're aware of this, Greg, Chairman Powell of the Federal Reserve System gave his semi-annual monetary policy testimony to Congress. And one of the questions he was asked was about the Basel III process. And it's reported that what he said is that there will be broad and material, that's the direct quote, broad and material changes to the draft Basel III proposal. Does that give you hope that these concerns that you have about lack of data, lack of good crisp analysis and so forth will be addressed?
Yes. I mean, I think there and elsewhere he has said that, you know, he believes that they should have an analytical database approach to these issues. We were very pleased to
So
hear
that probably means that they will take quite some time to assemble the kinds of missing information that you just mentioned and then repropose the rule. I would guess that would be the outcome.
I think he had some comments on that, which I have the transcript. But yeah, I think he said that that outcome was quite plausible. I think actually the day he testified, every Republican member of the committee wrote a letter saying that they should repropose it. I mean, the case for reproposal is basically, as you note, I mean, if you're going to show your work and if you're going to make substantial changes to what you proposed before, you kind of owe the public an opportunity to say, okay, well, here's the new idea, and you get to comment on the new idea. So, you know, we'll see. But I mean, I think his comments yesterday seemed to indicate that that was likely on the procedural side. But either way, you know, probably substantial changes coming.
Well, and in your letter, there's really substantial suggestions about how they could go about that, so that it would be my hope that your comment letter actually does give some guidance to the agencies as they do the reproposing.
Yeah, and I should say, I mean, there's a lot of angst globally about this. You know, we actually, I believe, you know, there is a benefit to having, you know, if it's done right, you know, common global capital standards. There's currently a lot of angst, I believe, in the UK and the EU about what if the US is delayed. They're much further along in their process, and potentially will have to go on if the US is delayed. I think having just gotten back from a European regulatory conference, I know they're quite unhappy about that. You know, I think our answer to them is, well, if the US had proposed something more akin to what you all proposed, then we wouldn't be having this problem in the United States. But it is, I think, going to be a global issue to the extent that the US delays. But that's sort of the nature of this at this point.
Well, it's so complicated that, you know, and it's essential that the US delay because the proposal is so deeply flawed, as you've pointed out. But it will take quite some time to do the kinds of analysis that haven't been done. Maybe they have been working on it, but still it's going to take time. And to repropose it, I'm guessing that Greg, you and the Bank Policy Institute are going to have this on your agenda for at least another year, if not longer.
I think that's probably the current consensus. So we'll see.
All right, we're nearing the end of our time here, but I have a question from the audience that I want to read to you, Greg.
Yeah.
And it's from Michael Falconer, who's
Oh, I know him.
you know that guy.
Yeah, hi.
He was at the Treasury Department under the Trump administration as Assistant Secretary for Economic Policy. And
I dealt with him on COVID relief, I believe. It was incredibly professional. Sorry.
Well, let me read his question for you.
Okay.
He says, Tyler Goodspeed and I wrote in the Wall Street Journal after the Silicon Valley Bank failure that excessive regulation that harmonizes banks is a potential cause of systemic risk, because if every bank has the same operating model, then if one fails, they all fail at the same time. And so Michael wants to know what your thoughts are on mitigating system failure versus failure of individual banks.
Right. Now, I think that's a great question. I mean, I think to some extent we were talking about this a little bit earlier, in the sense that that is actually the virtue of banks having internal models for credit risk and market risk. As I said, I mean, people just don't understand it. You know, they like the idea of banks competing, but all banks really compete on is the ability to manage risk, because you figure out what are you going to price that loan at. I mean, of course you can get more loan business if you have a lower interest rate than everybody else. But, you know, Bill, as you are quite expert in, the question is how low an interest rate can you justify given the risks? And you don't want every bank to offer the same interest rate to every borrower. You know, we have every success story in America is about, I went to 4 banks before I finally got the loan. But if you have a world where all 5 banks have the same, analysis because they have the same capital charge, and they all give you the same answer, well, that's not so good. So you can't say, oh, we want a vibrant competitive banking system. Oh, and we want standardized models at very high levels to govern how much capital banks have to hold against loans.
Great. So Greg, I want to express my appreciation for your participation in this. And we've got about 1 minute left. Is there anything that you would like to, as final thoughts, to share with our audience?
No, this has been extraordinary. You are quite the moderator, inquisitor. I think it's been a great look at the whole process.
Well, we appreciate your time, and as I said a moment ago, your work is not yet done. So
I'm just glad to see you're reading a lot of it. That's the real treat for today. I always tell people the best thing anybody can say to me is we read your stuff. So that's the one thing I would add. BPI.com, although that used to be the Bank of the Philippines, but I think it's now us. We put out a weekly thing called BP Insights, which comes out on Saturday morning, which is sort of everything that's happened in regulation that week, including any research we've done. You can follow us at Bank Policy on Twitter/X. And, for academics out there, we publish academic quality research by PhD economists, mostly former Fed folks, that are worth reading.
And one of the things I really like about what BPI does in that Saturday is you actually publish abstracts or summaries of academic research. So, and it's free of charge. And anybody, as I understand it, can get on your mailing list. So it's definitely been something that I read religiously. And it's
and also we don't skew it. We only include research with which we agree. We include everybody's developments that we decry as well as those that we acclaim. So
and complete with links. Well, again, thanks very much, Greg. We
Thank you
appreciate greatly your participation.